Hello, and welcome back to the channel. I'm Algabot, and this is where we take apart automated trading strategies for the MetaTrader 5 platform and study exactly how they think. Today we're looking at an expert advisor called Pivot Rejection Reversal. It blends classic floor pivot points with a candlestick rejection pattern, the pin bar, to fade price when it overextends and looks to turn back toward balance. By the end of this video, you'll understand how it maps out support and resistance, how it spots a rejection candle, and how it defines its risk on every single trade. Let's get into it. So what does Pivot Rejection Reversal actually do? At its heart, this is a mean reversion strategy. Instead of chasing momentum, it waits for price to stretch away from its recent center of gravity, tag a key level, and show signs of turning back. The engine behind it is the classic floor pivot calculation. Every 24 completed bars, which is the default pivot period setting, the strategy takes the high, low, and close of that block of bars and computes a fresh set of levels. The central pivot point, a first and second resistance level above it, and a first and second support level below. These levels are frozen for the next session and act as the map the strategy trades against. Once those levels exist, the EA watches for price to probe one of them and print a rejection candle, also known as a pin bar. This is a candle with a long wick pointing in the direction price was pushing and a close that snaps back the other way. A long wick below support with a close back above it suggests buyers stepped in. A long wick above resistance with a close back below it suggests sellers took control. Because it relies on clean, liquid levels, this approach is generally studied on major foreign exchange pairs like euro-dollar and pound-dollar, or on gold, using intraday timeframes. And importantly, the strategy is timeframe agnostic. The pivot session simply scales to whatever chart you attach it to. Who is this style suited for, in an educational sense? It tends to appeal to traders who prefer patience over frequency, who like clearly defined levels, and who want every trade to carry a predefined stop and target. As always, this is educational information only, not financial advice, and trading always carries the risk of loss. Let's walk through the mechanics step by step. The strategy acts once per completed bar. When a new bar opens, it knows the previous bar has fully closed, and it uses that closed bar to make every decision. This avoids reacting to a candle that is still forming and changing. First, it maintains its pivot session. Each closed bar updates the running high, low, and close. Once 24 bars have accumulated, it locks in the pivot point, resistance 1 and 2, and support 1 and 2, then immediately starts building the next session. Next comes the filter for a trade. The strategy only holds one position at a time for its magic number, so if a trade is already open, it simply waits. It also needs a valid set of pivot levels and enough bars to compute the average true range, or ATR, which measures recent volatility. Now the entry logic. For a long, three things must line up. The candle must be bullish, meaning it closed above its open. Its lower wick must be dominant, making up at least 45% of the total bar range by default, which is the wick ratio setting. And that candle must have dipped down to touch support 1 or the deeper support 2, while closing back above it. When all three agree, the strategy reads it as buyers rejecting support, and it signals along. The short side is the mirror image. The candle must be bearish, its upper wick must dominate the range, and it must have poked up into resistance 1 or the higher resistance 2 while closing back below. That combination signals sellers rejecting resistance, and the strategy signals a short. Now for risk. On a long, the stop loss is placed just below the rejection candle's low, with an extra ATR-based buffer set by the ATR stop multiple value of 0.6. The distance from entry to that stop becomes the defined risk. The take profit is then placed at a fixed reward-to-risk multiple, defaulting to 1.6, so the target sits 1.6 times further away than the stop. The short side works the same way, with the stop above the candle's high and the target below. Every trade, therefore, carries a known stop and a known target from the very moment it opens. Let's look at the actual MQL5 code that runs inside MetaTrader 5. At the top are the inputs, the dials you can adjust in the strategy tester. Pivot period is set to 24 bars per session. Wick ratio is 0.45, the share of the bar the dominant wick must fill. ATR period is 14, reward risk is 1.6, and lots controls the trade size. Below that are the two signal blocks shown on screen. The first is the long side. You can see the condition checks that the candle is bullish, that the lower wick is at least wick ratio times the bar's range, and that the rejected support helper confirms the bar dipped to support and closed back above it. When that is true, it reads the current ask price as the entry, sets the stop loss just below the candle's low minus an ATR buffer, and computes the risk. If the risk is positive, it sets the take profit at entry plus reward risk times that risk and calls trade.buy with the volume, stop, and target. The second block is the short side, and it mirrors the first exactly. It checks that the candle is bearish, that the upper wick dominates the range, and that rejected resistance confirms the bar poked into resistance and closed back below. It then takes the bid price as the entry, places the stop just above the candle's high plus the ATR buffer, and sets the take profit at entry minus reward risk times the risk before calling trade.sell. Notice that both sides return immediately after sending, keeping the logic to one clean position at a time. That is the entire decision, laid out plainly in code. Now let's bring it all together on the chart. On screen, you can see our pivot levels drawn as horizontal dashed lines. The central pivot sits at 1.0860. Above it, resistance 1 is at 1.0880 and resistance 2 at 1.0900. Below it, support 1 is at 1.0840 and support 2 at 1.0820. These are the frozen levels the strategy will trade against for this session. Watch how the first few candles behave. Price opens near the central pivot and begins drifting lower, candle by candle, easing down toward support. The second and third candles push closer to support 1 at 1.0840, with sellers still in control, but momentum starting to fade as price approaches that level. Then comes the key candle. The fourth candle drives down and actually dips below support 1, printing a fresh low beneath the line. But look at what happens by the close. Buyers step in firmly, pushing price back up, and the candle closes back above support 1, leaving a long lower wick behind it. This is the bullish pin bar rejection the strategy is waiting for. The wick dominates the candle's range, the close is bullish, and price probed support 1 and reclaimed it. All three conditions agree, and the buy entry marker appears right here. Notice where the protective stop would sit, just below that rejection candle's low, with the ATR buffer giving it a little breathing room beneath the wick. That distance defines the risk for the trade. From there, price begins to recover. The next candles turn green and climb steadily away from support, back through the central pivot and higher. As the rally extends, price reaches the take profit target, placed 1.6 times the risk distance above the entry. The long take profit marker shows where the position would close in this illustration. That is one complete cycle, a stretch down into support, a rejection, and a move back toward balance. Now watch the second half of the chart, because the strategy works both directions. After taking profit, price keeps pushing higher and now approaches resistance. The candles climb toward resistance 1 at 1.0880, stretching away from the central pivot in the opposite direction. Here comes the mirror image setup. This candle pokes above resistance 1, printing a high above the line as if buyers are breaking out. But by the close, sellers overwhelm them and drag price back down, closing below resistance 1 and leaving a long upper wick above. This is the bearish pin bar rejection. The upper wick dominates the range. The close is bearish, and price probed resistance 1 and was pushed back under it. The sell entry marker appears at this candle. This time the protective stop would sit just above the rejection candle's high, again with the ATR buffer, and the distance down to entry defines the risk. Price then rolls over. The following candles turn red and slide lower, back down through where the buying happened. As the decline runs, price reaches the take profit target, set 1.6 times the risk distance below the entry. The short take profit marker shows where that trade would close in this illustration. So across this single chart, you've seen the complete idea. Price stretches to a support level, rejects it with a bullish pin bar, and the strategy fades it back toward equilibrium for a long. Then price stretches to a resistance level, rejects it with a bearish pin bar, and the strategy fades it back for a short. In both cases, the reward to risk multiple of 1.6 defines the target relative to the stop. Remember, This is a clean illustration for education. Real markets are noisier, rejections can fail, and losses are a normal part of trading. And that brings us to the end of our breakdown of pivot rejection reversal. We covered how the strategy builds its floor pivot levels every 24 bars, how it waits for a pin bar rejection off support or resistance, and how it defines a stop and a reward to risk target on every trade. We also read through the actual MQL5 code and watched both a long and a short playout on the chart. Remember, everything here is educational content only and not financial advice, a recommendation, or a solicitation to trade. If you found this useful, please like the video, leave a comment with a strategy you'd like analyzed next, and subscribe for more MT5 strategy breakdowns. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.